Okay, I think there's a few more people still logging in, but I think we'll kick off, and they might just miss a little bit of my intro, which won't be the end of the world. So, welcome to How to Get Your People and Financials Exit Ready. Thank you for joining us. This is the third event in our series, which is focused on exploring the key factors that contribute to agency success and the essential steps that agencies need to think about and take to build value ahead of a potential exit. For those of you who can attend our previous event, we launched our latest research paper, which is based on how agencies stay ahead, the DNA of winning agencies. And that was based on insights from 10 quite in-depth interviews with agency owners of top performing agencies, those agencies that really are at the top of their game. And the report explored all the key themes of those success. So if you would like a copy of that report, please do let us know, and we'll be happy to share it with you. As I always say, quite a few familiar names on the delegate list, so lots of you know us already, but for those of you who don't, Moore Kingston Smith is a top 10 UK audit, tax and advisory firm. We work with entrepreneurial businesses across all different sectors, as well as not-for-profit and private clients. And we're also part of More Global, which is an international network with presence in over 100 countries. So we're very well positioned to provide advice to our increasingly internationally focused client base. At our West End office, we specialise in working exclusively with media businesses, and that spans marketing services, film, TV, theatre, gaming, and actors and entertainers. We also have a media and marketing services M&A specialism, and that sits within our 40-strong corporate finance department. And over the last 5 years, the media team has successfully completed 57 media transactions with a total deal value of 726 million. And our M&A team also works very closely with our M&A tax specialists, one of whom is with us on our panel today, given obviously that tax is a pretty critical component of any transaction. And some of the recent deals they've worked on together include the sale of Total Media Group to Service Plan, the sale of Wishu Studios to Keyword Studios, the acquisition of Shout Bravo by Incubeta, and the acquisition of Otherway London by Common Interest. You might also have heard about our recent mergers with Shipley's and Statham Gill Davies. Shipley's is a recognised leader in the film, TV and animation world. They joined us late last year and enhanced our specialism in the tax credits for film, TV, animation and video games. And our established legal services team has merged with Statham Gill Davies, which is a law firm renowned really in its expertise and its heritage in music and entertainment. And together they form a more SGD law and offer a full suite of legal services. So on to today's session, so how to get your people and financials exit ready. So our panel will be sharing our first-hand experience with you and practical advice on ensuring that your management team are exit ready and incentivised, why you need to be due diligence ready, and generally navigating the whole exit process around people and financials. So before we dive in, I'd like to just introduce our speakers. So we're delighted to welcome Barry Brienne, founder and CEO of Strat7. Barry has spent over 30 years in the marketing communications industry, holding a variety of C-suite positions at PLCs, PE-backed and private companies alike. Current roles include founder and CEO of Strat7, which is a global strategy, insight and analytics group. Non-exec chair and investor in Performance IO, a pharma performance marketing agency, and non-exec board director of Breakthrough T1D, the Type 1 medical research charity. Barry was also former group CEO of Creston PLC, a marketing communications group, which he grew via buy and build strategy, repositioned to the Unlimited Group before delisting it from the LSE. I would be introducing Paul Winterblood, who many of you who've been on these webinars before will know, and he leads M&S. He leads our media and marketing M&A offering at MKS, but unfortunately he has had to drop out due to illness. So Nick Thompson has kindly stepped in at very short notice. So Nick is head of corporate finance at Moore Kingston Smith and leads our team of 35 finance professionals who work in our specialist deal advisory, transaction services and debt advisory teams. And whilst Nick's M&A experience spans multiple sectors, He now specialises really in the IT services sector, but having previously focused very much on the media sector, during which time he advised on many deals, such as the sale of Edge Picture Company, award-winning production company, on its sale to Zinc Media, the sale of InSkin Media, a high-impact digital advertising company, on its sale to Azerion, the sale of Synergy Creative, which was an employee engagement creative strategy, to McCann, and advising on the sale of Creature, an agency, on its sale to Candid Platform, and the sale of Nudge Digital to TPX Impact. So lots of experience in the media and marketing services world. And last but not least, I'd like to introduce Mel Reid. She is a tax partner specialising in M&A, with particular focus on advising media and marketing services businesses. She provides tax guidance on corporate transactions to businesses of all sizes, but with significant experience in advising PE, venture capital backed and AIM-listed businesses, and has been involved in many of the deals that I have already mentioned. So this is being recorded, this webinar, so please do feel free to share it with your peers or anyone who was unable to attend today. And please do submit questions. This webinar is for you. You'll get the most out of it if you're able to ask those questions that are pertinent to yourselves. So please do ask questions via the Q&A function. It's much easier for me to keep track of them there, and then I will weave some of them into the webinar as we go, and perhaps save some of them to the end. So if everyone would like to turn their cameras on, I think we will start with some questions, and starting with you, Barry. So what I'm thinking about the people related issues first, I guess. So what are the traits of a high performing agency from a people perspective, Barry?
I know we've got a real mix of agencies here, sort of media, PR, marcoms, but yeah, I think it's pretty well the same for most of them. I think a really important element when I sort of look to advise a company or buy a company is making sure there's an alignment between sort of the founders and the management team in their vision, their ambition, and probably most importantly, the positioning of the business. Why is it unique? What is what is its differentiation in the marketplace? I have seen quite a few times a bit of a misalignment between the founders and the chief exec to the sort of more junior or even the mid-weight teams, and that usually just pulls the business in a different direction or hampers its future growth. So I think number one, making sure there is that alignment, and that's why a lot of companies have never liked the word, but they have their town halls, their group updates. But I think employee surveys really are very key, and it's amazing how few agencies actually do that as well. So not only see whether their teams are happy or not, whether they're motivated, rewarded well, but also from that cultural alignment to the vision and ambition of the business. I think also the retention and training and reward, yeah, that's important, but that's almost hygiene as well. I think the other area I look for is making sure that teams have got bandwidth to spend time with their clients. So often, and it's got worse, we're all short of time, and so many of our teams are just delivering. They're so up against it. The demands of their time is really important. So making sure to create those high performing agency teams, have they carved out enough time to go and spend with their clients, even reading their clients' annual reports and accounts, understanding the broader challenges the clients are under. I've seen it time and time again, whether you're an ad agency or whatever, you think that is the most important thing that the client is worrying about is the advertising or the brand campaign. And it's not. It is important, no doubt about that, but it's one of 20 important things they're dealing with. So again, really understanding what the client demands are internally from all of their stakeholders, externally what's happening in the marketplace, thinking beyond the sort of the delivery, the day-to-day delivery. So there are a few points, and probably the last one from a management team perspective, making sure they've got who's responsible for innovation. I mean, the pace of change we're all going through at the moment. Of course, everyone talks about AI, but it is having a big impact. So who is worried about that? Who's thinking about it? Who is thinking year to 2 years down the line in terms of the automation and improved productivity AI will bring, but also the new services, the new revenue streams that will bring as well. So, sorry, a bit of a long-winded answer. There's so
That's fine.
very big question.
Yeah, it is a big question, but I think that gives us a good flavour for the sort of the key traits. And I mean, as a buyer yourself, having made many acquisitions over the years, what do you kind of look for in a management team when you're looking at acquisitions?
Looking for a shared ambition within that management team, but also a shared ambition with what you as the buyer, what we're trying to achieve. Whether it's when we're building an Unlimited group, making sure we've got shared ambition and really putting the client at the center. What are we trying to create in the market? With Strat7, how we're bringing together the technology of market research and analytics with growth consultancy. So what are we creating new in the marketplace? How are we servicing our clients? There's no point doing an acquisition of that team. They could be as good as they are, but if they're just going to be sat on the sideline, isolated, then that's not helping us as a team. It's not helping our clients. So I think the shared ambition is really important. What are we trying to create in the marketplace? And is there really strong second tier management as well? The family, I've worked with, the Saatchi brothers, Frank Lowe, they're pretty big characters. And what's important is that second tier underneath them. So every time I look at an acquisition, sadly, I've got it wrong where you've seen the founders just walk out the door as soon as their earn-out's finished. And that's a disaster. It's not good for the team. It's not good for the legacy of the business. But so, having that second tier management with decent shareholding, decent skin in the game is super important as well.
And what about from an advisor's perspective, Nick? What sort of things are you looking for?
So I think something that we've seen quite often, too often, is management team who maybe they might have EMI options, or there's a vendor financed MBO being put on the table very kindly for them, that they don't actually have that conviction when the time comes to move from being an employee to a shareholder. There is quite a big difference, possibly in how much you are able to sleep at night because you're worrying about your employees and that sort of thing. But it does get a bit scary sometimes. So understanding, do they really want it? And this is difficult to know until the crunch moment, of course. And we see buyers get comfortable with the people through these chemistry meetings, management meetings you have during a sales process, trying to see if the goals are aligned, and they're entrepreneurial people that want to really drive the business forward when push comes to shove.
Barry, I mean, how honest are people about their reasons for selling, and how often does the wool get pulled over your eyes when they say they want to, work with you strategically for the next 10 years, and then they walk out the door the second the earn-out's finished?
I think 50-50 really. A lot of people, and I hate the word exit because that just means, you're selling and leaving. And it does surprise me when someone spent 10, 15, 20 years of building their business and their legacy, and they care so much about it and their teams and their clients. And it is probably rarity where people will walk out the door the next day. So yeah, be honest. The last acquisition I did, Colin, it was a really interesting, smallish insight agency called Rainmakers. But from day one, it was very clear it was his retirement plan. And there's no getting I won't say how old he was, but he was over, past his 60s. It was very clear it was a retirement plan. And, credit to him, he explained that's what he was. That's what it was. But, this is the second tier management. We went through their ambitions, what we could do with the client, what other services we could sell, not to sell, but embed into that client. And I think actually we've given the team more opportunities, more career opportunities. They're working on new clients. They're being exposed to new capabilities, so they're learning. The clients, we haven't lost any people, any clients. The clients, we're helping them with their growth. We're selling more services into them. So actually being honest up front about why you're doing it helps the buyer, because I think the days of just buying for earnings sake should have gone by now. Yeah. I mean, I hate to say, I remember when I first joined Creston PLC, the chief exec then was like, well, we just buy this EBITDA, that drives this EPS, we have this price to earnings ratio, our share price goes up. It's as simple as that. Go through that.
Not anymore.
Suddenly you're like, Christ, I've got all these companies, they're not working with each other, there's no collaboration. You look at, even S4 Capital, I mean, Sorrel is amazing in many ways, but you look at the value deterioration there, you've got to bring the companies together more now. So I think there's a lot more focus on what is the upside, how are we going to grow that company, that team, that client base, and it's no longer just trophy hunting, the old Saatchi days when they have 3 ad agencies, 3 PR agencies, 3 direct marketing agencies. It's more about how do you build that collective. Well, I hope anyway, that's it should be.
Exactly. Somebody's asked an interesting question. They've asked, how often do you find that the founder has actually taken the business as far as they can, and the buyer is relieved to see them go to unleash the energy of the next tier management? That's an interesting angle.
Yeah, I'm in a conversation with a firm at the moment. The founder, he only launched it a year and a half ago. It's gone through huge growth, but he recognises. He said, "Look, I'm an entrepreneur. I'm good at starting businesses. I'm a terrible manager," and so he's already trying to find the right home for it. Of course, there's a little bit of he wants to get the money off the table as well, which is fine. But again, he's been very open and honest about it. And very often, founders are not good managers. And I don't mean that in a disparaging way. It's a different skill set. It's really hard to start a business, grow a business, have personal guarantees on your house, not pay yourself a month's salary. You've got to have real resilience. And when a company gets to a certain size, if you want to take it to the US or hire more people or China, whatever it may be, sometimes you do need a different person to manage that business. So I think it's quite refreshing when a founder is like, look, I'm more than happy to go from chief exec to group strategy director or chairman or whatever it may be, but that is actually a refreshing perspective, because again, you're thinking about your team and your clients rather than your ego.
And do you have any examples of where the people in an agency that you've been potentially considering for an acquisition have been either particularly strongly or poorly positioned?
Yeah, it seems too many. I mean, I won't say who it was, but a friend of mine said, look, can you please talk to these individuals, because they've been with this business for 10 years. They've got all the senior client relationships. They've been trying to ask for longer term incentives. They've suddenly been told that the business is up for sale. And the founder obviously has been told by his advisors, you can't have 99% of the shareholdings, you won't be able to sell it. And he went to them and said, okay, you can have basically 5% each, but with these growth hurdles. So if I get X amount of value, you'll only get, value above that, and you've got to sign it by tomorrow. I mean, utterly insane, because those two individuals who really have driven the business are now, whatever they get, they're going to be completely demotivated and already thinking about leaving. And starting up on their own. And I said, I think you should too, because you're now going to work on an earn out, 3, 4, 5 year earn out, and actually still 90% of the value is going to go to this individual who hasn't looked after you. So I've certainly seen cases like that where it's been a greedy founder and is not thinking about the broader team, and you're only as good as your team, so you have to share the reward, because it's bloody hard work as well. Hard. So that is one example. I did advise a company. I came off the board in the end because it blew up, because the chief exec was just the founder. He was brilliant and inspiring, but he completely believed his own hype. He believed the company was going to keep growing at 30-40% a year and will be worth 500, well, 1 million, 200 million, 500 million. Every time I said to him, it's a multiple of revenue or multiple EBITDA, here's the deal structure, here's the maximum value you could get. And then he took on a minority shareholder, and he he spent all the money, and again, stupidly, he agreed to cede control if he didn't hit these huge hockey stick growth hurdles. And all his advisors said, do not do this, do not sign this deal. But again, he just believed his own hype. And the entire management team walked out with nothing. He got kicked out. And then the company's barely worth $1 million now. So sometimes, again, going back to your first question, sometimes it's good for the founder and the entrepreneur and the start, the guy who started up to sort of move to one side, because there are too many examples of that.
Yeah, yeah. And Mel, just coming to you from sort of the tax angle and having a huge amount of experience in putting sort of share schemes and the like in, what options are available to agency owners that want to incentivize the senior leadership team?
So, I mean, it's interesting just hearing from Barry in terms of, I think the wording you used was got to have some decent skin in the game. And I think that's probably the first piece of advice that, I would always say to anybody, giving somebody 1 or 2% if they're of the business, if they're completely key to the future success, actually probably has the opposite effect. So I think it's about working out who these individuals are that are really key to the future success and making sure they've got enough that is going to drive them forward and also look attractive from a sort of buyer's perspective as well. In terms of sort of structuring that, I mean, we talk about EMI all the time. If you can EMI stands for Enterprise Management Incentive Scheme. It's a sort of HMRC tax approved scheme. If you can structure it to get within that, if your company qualifies, then that is always, well, 99.9% of the time that the way to go, because there are so many tax advantages from it. And I think the important thing, again, to Barry's point, is probably to do it as early as you possibly can once you've got your management team structure in place. We quite often get people come to us just before a deal, said, I've been meaning to do this for years. And it's quite difficult to do it then, and also doesn't necessarily have the right motivational drivers. But I think the other thing as well we see a lot of is, and again, Barry referenced it, the sort of hurdles where it's almost the founder saying, well, I've generated all of this value. That's mine. You can only have value above this particular hurdle. And that might be right commercially for the business, but I think it's about recognizing that the team probably helped get there as well. So giving away some of the sort of past value isn't necessarily as detrimental to the overall value. Hopefully it's value enhancing. And I think we're pretty good here, Esther, working as a team at actually modeling the commercials of it, as well as just what the tax incentives are.
Yeah, and there are some tax advantages as well, aren't there, Mel, of getting your scheme in place well ahead of the deal?
Yeah, I mean, if it's structured properly, then option holders should be able to benefit from capital gains tax rates on the sale, and even business asset disposal relief, which gives you currently a lower rate of 10%. If you do it further down the line and you're in a deal cycle, it's very difficult to structure any sort of value that isn't subject to income tax rates. And there's benefits for the company as well, which potentially would look to enhance the overall equity value of the company. So lots of reasons to think about it early and try and get it in a sort of tax advantage scheme if you can.
Yeah.
Sorry, Mel, I don't think it's very tax efficient, but I was going to say quite often sort of the shares, and I've seen it time, EMI options are given to the people who join first, and they may help in those first 1 or 2 years, but they're not necessarily the people that are going to drive the growth over almost like year 5 to year 10. So again, if you can hold back some options to award later on, I think that's really good, but probably not as tax efficient if you awarded them at the beginning.
Yeah, it's about getting the timing right on it, I think, Barry. Who are the right people? What's the strategy? It's not just first in the door that gets the options. It's about, what is the plan? Who are the people that are going to do it, and how are we going to reward them, and then reward them at that time, not once you've got an offer on the table, which I think is probably to your point, Barry, that quite often is something you've seen, and it's something we see a lot as well.
Yeah.
Yeah, yeah. And Barry, I mean, when thinking about how much is enough, what sort of percentages, what's the range of percentages you would expect to see sitting with the SLT?
I think if I typically see less than 20%, I would want to, and again, I know it's not tax efficient, but I would want at least 10-20% of the earnout being given as a, call it a transaction bonus, or 20% of the earnout going to the broader team and broader staff. I would see 80% is too concentrated in one or two hands. So again, I'm just in a conversation with someone and they've got two founders who got 97%, and they seem really proud that they've got 3% for the third partner. Right?
What's the point? Yeah.
Derisory. You're working all these years post tax, you're going to get 100, 150, 200 grand. It's ridiculous.
Yeah.
So I think anything under 20%, I would want to top it up by taking a slice of the earnout to pay almost as a bonus at the end of the earnout period. Because again, what you don't want in an earnout period is the rest of the team that are doing a lot of the delivery, building the client relationships, all thinking, I'm working 15 hours a day to make them richer. Why am I doing that? It's that dissension. People unhappy. They're going to walk at some point as well, whether it's mid earnout or post earnout. And all sellers seem to forget that from a buyer's perspective, the buyer needs a return as well. And if you're selling a company for 8 times, that's usually 8 times EBITDA pre-tax. So if that company's flat, post-tax, and if I don't get any synergies, no growth, it's going to take me 10 years to get £1 of return. Everyone seems to forget that. So, you as a buyer, an acquirer, you have to have a return as well. So you need growth, and to get the growth, you need the retention of the team. So having that retention level is really, really important.
Yeah. Nick, just coming to you. I mean, how can you get involved in sort of helping agency owners to assess, who are the right people to incentivize? Is that something that you get involved in?
Yeah, we can. It is quite difficult because our clients know their people far better than we ever could. And there's no real formulaic approach that we believe works. There's sort of these tools like the skill and will matrix, which is about competencies and motivation. And really, we prefer to take a sort of a more discussive approach, challenge what our clients think about their management and individuals on a one-by-one basis, to really make sure that they are confident that their sort of thinking is correct. We see quite often that our clients think that they can show that they have a good management team and have made the right decisions by having given people job titles a few years ago in advance of selling, or having given them share options, that kind of thing, as well as praising them during management meetings. But really, it is more than that, and some special thinking, proper time needs to go into it to make sure you've got the right people, and you're actually letting them manage, rather than making it all just for show, I guess is our point.
Yeah. And somebody's asked an interesting question, actually. Can you have too many option holders?
I guess in theory, no. I mean, there are certain EMI limits. You can't grant options with, of more than £3 million of value. So there are certain sort of statutory limits if you want to try and fit within EMI. But I think ultimately, back to Barry's comment, if you've got 100 people all with 1% each, is that, well, actually that wouldn't be right, but 0.5% or 0.25% each, is that really the right structure and incentivization, because you've probably just got an awful lot of people that are maybe not actually that incentivized and might get 15,000-20,000 pounds each out of a transaction, but that's probably not enough meaningful for them to do it. I mean, it used to be quite popular to almost give everybody options, particularly in tech startups, going back a number of years, but that was almost in compensation for salary. But when we're talking about this space, I would say it's unusual to have hundreds of option holders, for example.
I think it would cause a lot of complications as well around deal time. Option holders often don't see SPAs and exactly what's happening until quite late on, and it's vital to bring them all on board. Have been honest and upfront with them, from the first place, but you can't talk them through and tell them whenever you're in due diligence and things are progressing until you really believe a deal is happening. And we quite often see I guess, panic that a deal's about to happen. So if you times that by 100 rather than 10, it would be quite a headache, I think.
Yeah, to Nick's point, when you're looking at a deal, big important element is how easy is it going to be to execute this deal, to get it done, to get it complete. Even for a small company like us at Strat7, the due diligence is going to be anywhere between £200,000 to £300,000. So it's expensive, it's massively time consuming. It's really embarrassing to my board of investors if we don't get it over the line. So if I looked at something that had 50 option holders, I'm like, oh God, this is going to be a bit painful. And second, and also two other things coming off that, I think, okay, there's going to be quite a few junior people that could be getting 10, 15 grand. And I've seen it, 10 grand for someone who's 27, 28, like, right, I'm off traveling for 3 months, and they all piss off. They're like, okay, that hasn't helped. And then lastly, I'm then thinking straight away, okay, basically you haven't been rewarding the people properly on an annual basis, annual compensation, base salary, bonus. So now my salary bill is going to be going up post deal. My margin is going to go down. I'm going to get people demanding salary increases, etc. So again, it's a bit of a warning. I know it's sort of contradicting. It's good to spread it, but if it's spread too thin, I'm now, because doing a deal is so much about mitigating risk. How am I mitigating risk? And that is just another amber flag. I've got too many people that could be leaving, especially that midway, because of even a 5-10 grand bonus is like, thank you, I'm off to Australia for a bit.
So I think that's a resounding yes, you can have too many option holders. Don't spread it too thin. It can cause all sorts of complications. And certainly when I'm talking to my clients, I always say, if you've got 25% to play with, give it to a small group of people who are the key senior leadership team, people who you might put in front of the buyer and introduce to the buyer themselves and have the conversations. Do not spread it too thin. You'll be wasting your time. So going on to financials then. So Nick, we do lots of financial benchmarking, a lot of which stems from the annual survey that we do. So maybe you could tell us a little bit about that and how we use that to understand the key value drivers in an agency. Oh, you're on mute, Nick.
It's a bit amateur of me, isn't it? Sorry. So the annual survey looks at publicly available financial accounts across the sectors, and we collate them and use the data for sort of top 20s and Hall of Fames around what are the financial KPIs that are characteristics of the most successful agencies. And really that is what is best in class. And something to try and achieve. And I think not many businesses necessarily hit all the benchmarks, but it's reach for the stars sort of stuff. And then we use those to help assess value for our clients before they go to market. We use them for sort of due diligence. Our accounts audit clients can see how they're performing against their competitors and the sort of industry norms. And I won't go through all of the KPIs that sort of brought out of the survey from last year. I think the key ones are fee income being more than £130,000 a head, and staff costs as a percentage of fee income being sort of no more than 55%. We try and sort of target operating margins of more than 20%. And then in terms of the balance sheet, net current assets of more than 3 months of overheads. So if all the projects switched off or moved to the right, you could keep going for 2 or 3 months. We often think 2 is probably enough, but we always say 3 just for best practice. So you could keep trading and not worry about having to make cost-cutting decisions, which is never a great idea during a short-term blip. Now, those are sort of from the top 50 rather than by individual subsector, which do have their nuances, of course. but are useful benchmarks just to have, compare yourself against in your MI as you grow to become best in class. And I think that is part of what feeds into valuation multiples. So we think there's qualitative and quantitative factors that come into play. So something like KPI benchmarking, very much a quantitative factor, but then this stuff we've just today, the people, value proposition, owner reliance as well, and income security and reliance is a big one. And all of those, including your financial performance, they're going to come up to whether you're a 6 or you're a 7 or an 8x multiple, which has a huge impact on your valuation and what you can achieve.
Thanks, Nick. Anyone who hasn't seen the survey, it is available for free if you're a client, or to buy if you're not a client. And lots of people really do look forward to it coming out and seeing where they sit against all of their competitors and trying to work out who are the ones to beat. I mean, Barry, just coming to you as a buyer, what are the key metrics that you're looking at from a financial perspective, or indeed a sort of non-financial perspectives as well?
Yeah, so I'll start with non-financial, because it will be, again, okay, what's this giving us from a capability perspective, geographic reach, clients, is it giving us new clients? How do we grow those clients? So that's, why we're buying it, why do we need it? Then it'll be, how can we help them grow and how can they help us grow? So is it a new piece of technology that we can apply across to the rest of the group? Is it, like I was mentioning, the last acquisition that joined us, they had a big client in MetLife in New York, and we've managed to grow that by close to 50% within a couple of years by selling other services into it. So it is, for us, it's about growth. How can we help them grow and how can they help us grow? Then going into the sort of the valuation, then starting to look at the financial metrics, but it would be very much around the management team. Who are they? What's the second tier management? What's the client spread? Is there client dependency? Are the clients UK based, global based? On the client dependency, the amount of times I see 50% with one client. Oh, don't worry, it's all different buying. Okay, is there one MSA? Yes, but don't worry, it's all multiple buying points. Okay, is it one procurement person? Yes. Okay, fine. That's one client. Yeah, end of. Because if you piss the client off and the business unit, then it will come through to procurement. So client dependency, client spread, and the financial KPIs, the typical ones: revenue per head, comp to revenue percentage. Margin is important, but I remember when I was non-executive of a company, they were obsessed by the sort of getting to 25% margin. I was like, okay, well, that's great, but again, I'd rather 2 million EBITDA at 10% margin than 1 million EBITDA at 25%. If I'm selling this business at 6 times EBITDA, do I want 12 million or 6 million consideration? Oh, I want 12 million. And then for the buyer, I'm now looking at it. How do I grow that 10% margin to 20% margin? Is it doable? If it is, then that growth is helping me, post acquisition. So if I've got 25% margin business in front of me, I can't grow that margin. It's fully maxed out in a way, unless it's a tech business. So therefore, it's all about top line growth, which is difficult, which is tough. So yes, a good margin is important, but even if you're at 10-12%, as long as you can explain why you are there, you've been investing, and where the growth is going to come from, then again, it's not just a buy. Think about it as an investor. What's the next 3-4 years ahead? How can I help them grow? And if I can double the margin to 20% and increase the top line by, say, 10%, and I can sell other services into that client and vice versa, then that's a double whammy. That's a great thing. So I don't know. Sorry, it's a bit of a long-winded answer. I'm not sure.
Yeah.
So there's so many. I got full grid. Enterprise client, domestic client, and multiple different there. Margin, recurring revenue, license-backed revenue, repeat revenue. All of these things are important. But personally, it comes back to why we're buying it. why
Yeah.
capability in the group.
And I guess all these key metrics sort of help you to inform what you think a target is worth and what sort of deal structure you might wrap around that.
Yeah, because the deal structure can be a you know, so multiple way. It can be a multiple of EBITDA over 3 year. We're doing far more multiple of net revenue. So because for Strat7, it's very much we are a joined up group of specialists. So I want to keep the brand and that go to market offer, but everything below the direct team, all overheads, and we need to integrate into the one platform. Because when you do that, you do all the legal hive ups, you've got one limited company in the country, per country, then you can have one client MSA, and then you can really drive the collaboration. We've got annual bonuses on our group EBITDA. Yeah, we're making a massive effort to move away from siloed P&Ls. You know, this comes back to what is the shared growth and shared ambition that we talked about right at the beginning. So deal structures, they can be 1 year earn out, 3-4 year earn out. A lot of people don't like earn outs, but actually there is a bit of a client dependency or management dependency. That's not a bad thing. If you're on that sort of 10% margin, you want to grow it over 20%, and you've got a couple of years as the shareholder and as the seller to sort of get value and benefit from that margin growth as well during your earn out when you're being paid typically a multiple of EBITDA or a multiple of revenue.
Somebody's asked specifically to you, Barry, to what extent is the complete removal of back office services like finance, etc., a normal part of an agency acquisition?
I don't think it's normal at all. I think it should be. I think for the larger groups, they still typically working on multiple systems. I think for Strat7 starting, and we've started right from day one, right, we're going to have one CRM system, HubSpot. We've just moved 4 HR systems into one, Suzanne. We've moved on to one ERP system. We've moved on to one Microsoft tenancy, so we can actually share pitch presentations. I can do a quick Teams call to someone. If everyone's on different systems, you can't get the collaboration. You can't do it. Whatever people say, you can't do it, because yes, we can turn up to a meeting together, but how am I sharing documents? How am I sharing new business programs, marketing, sharing client contracts, even we're moving people from the UK to the US or between agencies, and it's much easier. We've aligned the benefits, we've aligned the payrolls, etc. You know, because if I move someone like, oh, why have you got 5% pension? I've got 10% pension, or I've got a 4-week sabbatical and I don't even have a sabbatical. So you have to do this, otherwise it just creates problems down the road.
What about post-acquisition? I mean, how do you use those financial metrics to drive performance through the sort of the integration period and I guess when, you know, generally growing the agencies?
I think the comp to revenue ratio, you know, what is the salary bill? Because if someone is very inefficient, you know, why is that? And then that's almost unfair on the other teams. And then if you're going to be allocating investment, where do you allocate it? Do you actually want to allocate it on the poorer KPI business to get that, you know, up to a higher level? So you need it as management information. And also, you know, Strat7, we're PE backed, so our financial reporting is very important. But it's not just private equity. When I was running the PLC, you know, the management information is super important then, and just as much so. You're still doing monthly reporting, doing quarterly stock exchange reporting, half-year stock exchange reporting. So there's probably more demands on you as a public company than a private equity company. But if you haven't got good MI, you haven't got good forward KPIs, then God help you.
Yeah, well, I think that segues nicely on to thinking about management information and how important that is. I mean, it sounds like a fairly basic requirement, but actually, you know, it can form a pretty important part in the sales process, can't it, Barry? I mean, I'm sure you've seen good and bad examples of the MI that people have been able to provide you throughout the due diligence process.
Yeah, I mean, the biggest one is cash accounting versus accrual accounting. I mean, honestly, I'm in the middle of 2 deals, and one their EBITDA has gone from 3.5 million to 2.5. Like, what happened? Oh, well, we finally brought in an accountant who's figured it out. Another one went from 1.5 to about 800, so almost halved in their EBITDA. And the problem with that, they've now got a value expectation that's completely unwarranted because their EBITDA is half of where it was. Well,
Yeah.
it wasn't, it was bullshit. So yeah, I think it's really, really important to have a good FD or good accountant, or even if whatever size of business you can have a fractional sort of FD. And if you're going into a process, having a good FD on the other side, just it goes back to, am I going to get this deal done? If I'm not, then it's going to be a bigger distraction than it should be. And a good FD, as you're a seller, will pay themselves back. Yes, they're expensive, but for 150 grand, if you're selling your business for 10 million, honestly, they'll get that. They can easily make you 500,000, 1 million very easily. Just in as you were saying, Nick, on the networking capital, if you're going to be arguing 12 months look forward, 12 months look back, or 6 and 6 months on a networking capital requirement, half people may not understand that, but that will easily get you 50 grand, 100 grand, or in the tax for mail, the tax relief on the EMI options. As a buyer, you try and say, no, you're not getting that relief. But again, there's value there. So a good FD with good management information will get a deal done and pay themselves back quite easily. I mean, Nick, I don't know whether you've seen that. You must have done.
Well, I echo everything you said and more. It is poor MI financial records or sort of general, whether it's financial tax, legal compliance, is the number 1 reason why we see value left on the table. It's for so many reasons. Deal execution risk, where the goalposts move in terms of what you've presented in your IM versus what reality is coming out of due diligence. There's a little bit of sort of the equivalent to messy handwriting for the marker of the exam being your due diligence provider. It puts them in a bad mood and quite negative, and also makes them feel like there's risk. They don't feel comfortable that this information is reliable, which just in their minds will make them come up with more points to their clients, to the buyer, which will end up in sort of more on the list of their way at price and that sort of thing. And most of what we do is getting involved towards going into market, that sort of thing. I'm sure Barry will sort of feel this more, see this more. Having good MI is not just good for selling your business, it's good for running your business. It makes so much sense to ensure that you've got really good sort of dashboards, live, accurate information to help you run a business. But then also, it's so valuable when it comes to exit that it's a massive win-win. Just one last bit on that. If you're growing as a business, it's difficult to prioritize budget on FDs and compliance and that sort of stuff. But you really need to be mindful of, if you're planning to exit in the next few years, it's from that point you need to have your house in order, because the financial due diligence will go back 3 years probably, and forwards a couple of years. You really need a financial model, and then tax will be proper deep dive the last few years, but can go back. Is it 7 mil? But it's 7, yeah, I thought so. It's not just about sorting it out for the last year before exit, I think is what I'm trying to say long-windedly.
What other things, Nick, do you need to think about getting ready for in the DD process, other than the sort of financial stuff?
I think having resource to get through it is really important. So having that finance team that are able to get on with the day job and deal with due diligence requests, and that is the same for management as well, and sort of agreeing who's going to be doing what to keep the ship going in the right direction. that's probably the main things. I mean, there's the legal elements, but that's not necessarily my arena. Making sure you've got all your contracts and everything up to date, and in order, again, makes the legal DD providers have more comfort, and makes you look, like a more impressive, organised management team.
I think
Yeah, I
it's,
mean, I see a lot of people sort of setting up a data room, sort of maybe, a couple of years out from a sale and starting to populate it, because actually it takes a long time to pull all of the documents together if you haven't got them ordered well, because they, throughout the DD process, anything is game for being asked for.
It's certainly good practice to sort of, I mean, you can probably Google it, what should go in a data room, and start thinking about what you'll be being asked, and is the information actually correct? And they're uploading, yeah.
it's really, I don't know how much time we've got left, but we're coming to the end.
8 minutes.
It's really difficult. It's when you founded a business, you've done it with passion and a vision to create something. You're so proud of what you've built in terms of your market positioning, what you've been doing for clients and your team and your people. And then please don't take this the wrong way. Then you get a whole load of people like me as well, the lawyers, the tax accountants, the accountants, just the hell out of your business, and just it comes across as really critical. But again, I would, if anyone's selling their business, yeah, as you said, Nick, think about this 2 years in advance. Just the deal process takes nearly a year from when you first appoint someone, like Esther, or
Yeah.
start the process. You've got to get everything ahead of that. You also got to get your head around, you're selling your business, you're selling your independence. You are now answerable to other people, not answerable, but other people are going to have a point of view on decision making. And then you're going to go through a hell of a process. A lot of deals fall over. I mean, I've walked away from multiple deals at the last moment because training's coming off, because all the founders are involved in the deal and not thinking about their clients. Or, again, it's easy to do a deal. It's afterwards. We've got to keep growing it. And so what is the plan afterwards? So find the right home. Don't go for the highest buck, because then that's a disaster as well for you, your team. And life's too short. You've got to enjoy where you sold to as well.
You have indeed. And Mel, from a tax perspective, I mean, goodness me, I mean, we see so many problems come up on tax due diligence, don't we? There's so much to think about there.
Yeah, agreed, Esther. And I mean, I think not necessarily something you can do in advance, but probably to Barry's point, don't necessarily take it personally. You are going to be DD to death. Things do come out of the woodwork in terms of tax, that maybe things haven't been done completely correctly. That's that needs to be addressed as part of the deal process. But I guess don't take it personally would probably be, I guess, a word of caution. And probably, I think the other thing I would say is, if you're expecting a certain tax outcome from the sale of your business, whether that's you're paying a certain rate or you're getting capital gains tax treatment rather than paying employment taxes, check out that that's actually what the real position is, and it's not on the basis of something that was implemented 10 years ago and has never been looked at since, or a conversation with somebody that sold their business a few years ago. Because we see often people expecting to pay a certain rate and not, and then their valuation expectations aren't met, and then the wheels start to come off effectively. So I think checking you're going to end up where you think you are early on would probably be one of my tips as well.
Thanks, Mel. And then Barry, I mean, you sort of alluded to it before, but sort of like, we also need to think about what's going to happen post-acquisition, because there's so much energy goes up to the final event. What you don't want is everyone breathing a sigh of relief and relaxing after the deal happens. So what do you sort of look at as part of the whole sort of integration and value creation process post-deal?
Yeah, so for Strat7 now, even as part of the heads of terms, which is main commercial terms being signed, within that we will agree an integration plan. So how will your business be folded in? I think that's really important, because it does, people then they worry about their brand, their finance system, bizarrely, then employment contracts, and just so everyone's aligned as to what's going to happen with all of those. And then between signing heads and having a deal completed, I would want to look at the sort of the client strategy. What are we going to say to the clients? And a sort of team strategy as well. How we're going to explain the upsides for the team and for the client. So I think those are really important. And then who's going to be doing, and sorry, what the growth plan is for that business. Are we launching in the US, or what other services do we need to invest in? And then finally, if there's 2 or 3 main founders, what are their roles going forward, even during the deal? Because I've seen that too many times where trading's come off for the first 3-6 months because they've all been completely distracted doing the deal, because they get excited by it, they want to learn from it, and they lose value because typically they're in an earn-out model. And so when you're getting paid 6, 7, 8 times your EBITDA, and you've suddenly had 3-6 months of terrible trading, you've lost value again. So again, who's doing what divide and conquer, what are the roles and responsibilities of the senior team?
Yeah, absolutely. We are nearly at 11 o'clock, but I think we've got time for one final question. Top tip from each of you to any agency owner that is looking to exit. And maybe we'll come to you first, Nick.
Make sure you've got alignment of the shareholders and their desires and what they want out of this in terms of valuation and length of earn out. So everyone's on the same page and no surprises.
Mel?
I think maybe consider the preparatory stage for it. We've talked about DD, but actually making sure your outcome is going to be as expected from a tax perspective, whether that's putting together a data room in advance or doing some sort of vendor DD beforehand to flush anything out. I guess it depends on how long the business has been around for, and whether it was a lifestyle business perhaps beforehand and has been professionalized more so over recent years. But yeah, preparation, I guess I would say.
And Barry?
I think just be honest. To Nick's point, what do you want out of it? Being honest about the next part of your journey, the company's journey. I think find the right home for the team and for the clients. It's not just about money. So honestly, you could get 10% more and you're going to have just a horrible experience for everyone. So don't just follow the money.
That's good advice from all 3 of you, and I'm sure everyone will be taking lots of notes on this webinar because lots of really useful tips come out of it. So thank you everyone for joining, and thank you very much to our panelists for sharing all of their insights with us. Like I say, lots of valuable tips to be taken away. We've got another in our agency exit program series of webinars coming up in March, and that will be on exit permutations, aspirations and valuations. So hopefully some of you will be able to join us there as well. I think there's a couple of questions left, so we'll pick those up and answer those to you individually. But other than that, thank you everybody. Enjoy the rest of your day. Thank you.
Thanks very much. Thanks everyone.